The current time is Sunday, November 23rd, 2025. The markets are currently closed, but the last trading session on Friday ended with SoFi Technologies, ticker symbol SOFI, closing at exactly $25.19. This figure is not just a number on a screen. It represents a chaotic, fascinating battleground where the stock has pulled back significantly from its recent highs of over $32 earlier this month, leaving investors scrambling to understand if the rally is over or if this is the ultimate buy-the-dip moment. If you look at the intraday action from Friday, we saw a consolidation pattern where the stock fluctuated between a low of $23.52 and a high of $25.44, finally settling at that $25.19 mark. This price action tells a story of exhaustion after an explosive run, but also of resilience, as buyers stepped in aggressively every time it dipped below the $24 handle. The expectation right now, the narrative flooding social media and financial news outlets, is that the fintech trade is overheating. You have analysts screaming that the run from $8.60 to $32 was too fast, too furious, and that we are destined for a massive correction back to the teens. That is the expectation, that gravity is about to take hold of SoFi and pull it back down to earth alongside other high-growth names. But the reality is starkly different, and it is something most retail investors are completely missing. The reality is that SoFi has fundamentally decoupled from the unprofitable tech basket, with the release of the Q3 2025 earnings showing revenue hitting $961.6 million, a staggering 38% increase year over year. We are no longer looking at a speculative bet. We are looking at a cash flow positive machine that is effectively eating the lunch of legacy banking. The reality exceeds the expectation because while the market is fixated on short-term price fluctuation and the drop from $32, the underlying business has just posted its most robust quarter in history, confirming that the financial productivity loop is not just a slide deck buzzword, but a mathematical certainty that is driving exponential margin expansion. When you look at the chart, that pull from $32 down to $25.19 isn't a crash. It is a necessary ventilation of a heated engine. Investors need to understand the psychology here. When a stock triples from its lows, going from around $8 to over $32 in a single year, you are going to have profit taking. It is natural, it is healthy. But what is happening now is a rotation. The weak hands, the people who bought in for a quick trade, are exiting, and they are being replaced by institutional capital that sees the long-term vision. We are seeing volume stabilization around this $25 level, which suggests that the smart money is treating this as the new floor. This is where you have to separate your emotions from the data. If you are panicking because you bought at $30, you are reacting to expectation. If you are looking at the 37 cents EPS guidance for the full year and the massive growth in tangible book value to $2.5 billion, you are reacting to reality. Let's talk about the competition, because you cannot analyze SoFi in a vacuum. You have to look at the broader landscape of online investing and individual brokerage accounts. The biggest comparison is always Robinhood. Everyone likes to pit Robinhood stock trading against SoFi Invest. And yes, Robinhood has had a spectacular run as well, surging as retail investors flooded back into the market in 2024 and 2025. But here's the critical difference. Robinhood is a transaction-based business. They make money when you trade. If the market goes sideways and you stop trading, their revenue takes a hit. SoFi is building a holistic balance sheet. When you open a SoFi Invest account, you're not just trading stocks. You're likely depositing your paycheck into a SoFi Money account, taking out a personal loan or applying for a mortgage. The cross-selling capabilities of SoFi are light years ahead of the Robinhood app. While Robinhood is trying to pivot into credit cards and retirement, SoFi is already there, and they are doing it with a bank charter that gives them a cost of capital advantage that Robinhood simply does not have. This isn't to say Robinhood is a bad investment, it's just a different animal. Robinhood is a trading platform. SoFi is a digital bank disguised as a tech company. We also have to acknowledge the legacy giants. Think about Fidelity Investments or Schwab Intelligent Portfolios. These are the titans of the industry. For decades, if you wanted investment help or wanted to open an individual brokerage, you went to Fidelity Brokerage or Charles Schwab. They have the trust, the trillions in assets, and the history. But they also have the baggage. Their legacy tech stacks are cumbersome and expensive to maintain. SoFi, through its ownership of Galileo and Technisys, owns the very infrastructure that powers modern fintech. This is the AWS of Fintech thesis. When you use interactive brokers trading or look at a Fidelity trading platform, you are seeing a robust professional tool, but it often lacks the seamless modern user experience that Gen Z and millennials demand. SoFi bridges that gap. It offers the sleekness of Robinhood crypto with the burgeoning product suite of a Fidelity wealth management offering. They are capturing the high-earning, not rich yet demographic before they get rich enough to go to a traditional private bank. Let's dive deeper into the recent price action because the volatility has been nauseating for some. The stock hit a 52-week high of $32.73 recently. That move was fueled by a combination of the Q3 earnings beat and a broader market rally driven by falling interest rates in 2025. When rates fall, lending businesses like SoFi usually benefit because their cost of funding drops and demand for loans increases. However, the market got ahead of itself. The RSI, Relative Strength Index, screamed overbought, and we saw a sharp reversal. That brings us to today, sitting at $25.19. This is a battleground. The bears are arguing that the valuation is stretched at over 40 times forward earnings. The bulls are arguing that you can't value a hyper-growth company on trailing metrics. The truth lies in the operating leverage. As SoFi adds more members, now sitting at over 12.6 million customers, the cost to serve each additional member drops near zero, while the revenue per member climbs as they add more products. This is the magic of the digital model. Unlike a physical bank that needs to build a new branch to get new deposits, SoFi just needs to run a server. Speaking of products, we need to discuss the SoFi Invest platform updates. They have been aggressively rolling out features to compete with Interactive Brokers platform and Fidelity ETFs. We are seeing advanced charting, extended trading hours, and a cleaner interface for options trading. They know that to keep the active traders, they can't just be a light version of a brokerage. They need to offer real tools. And they are doing this while maintaining the simplicity that attracts the self-investing crowd. It's a delicate balance. If you make it too complex, you scare away the beginners who are looking for investing sites that are easy to use. If you make it too simple, you lose the high-volume traders to Interactive Brokers or Thinkorswim. SoFi seems to be finding that middle ground, effectively creating a funnel where a user starts with simple automated investing, similar to Schwab Intelligent Portfolios or SoFi Robo-Advisor, and eventually graduates to SoFi Active Investing, where they pick their own stocks and options. I want to pause here and ask you a question because this community is what drives these movements. Comment below how many shares of SoFi you currently hold and what your average cost basis is. Are you green from the $8 days, or are you holding the bag from the 30s? And more importantly, do you think the reintroduction of crypto services mentioned in the recent reports is going to be the catalyst for the next leg up? Let me know in the comments. Now, let's look at the macro picture for late 2025. The economic environment has shifted. We are no longer in the high inflation scare of 2022-2023. Interest rates have normalized, which changes the game for Fidelity mutual funds and SoFi ETFs. Investors are hunting for yield and growth again. The cash sorting phenomenon, where people moved money out of banks into treasuries, is slowing down. This means deposits are sticky again. SoFi's high-yield savings account is a massive customer acquisition tool. They bring you in for the 4.5% APY, or whatever the current competitive rate is, and then they cross-sell you into SoFi stocks or SoFi loan products. It's the classic land and expand strategy. And because they're a bank, they use those deposits to fund their loans. This is critical. Other fintechs rely on warehouse lines of credit or third-party funding. SoFi uses its own members' deposits to fund its loans. This vertical integration allows them to capture more margin than a competitor who is just a middleman. We also have to discuss the Galileo aspect. This is the hidden gem. Galileo is the tech platform that powers other fintechs. It's like selling shovels in a gold rush. Even if Robinhood Cash Management or Chime or Monzo wins, SoFi can still win if they are using Galileo's backend. In Q3 2025, the technology platform segment saw significant growth, proving that legacy banks and new fintechs alike are turning to SoFi's infrastructure to modernize. This diversification is what protects SoFi from a pure consumer credit cycle downturn. If consumers stop borrowing, the tech platform still generates fees. If the tech